determines the expected move. We talk about this an awful lot. It is extremely important for options trading. Here we're going to talk a little bit about an estimation and some of the simplifications that we can make. The expected move of a stock is the amount a stock is predicted to increase or decrease from its current price over a certain period of time, and it can be calculated from the current option prices. There's a couple different ways to calculate expected move, right? Expected range. We've talked about like back of the envelope calculations. We've talked about using like straddle prices and then some other techniques, but there's a couple different ways to do it. And again, it's really important to actually use this when we determine like strike prices, also, but like more active trading and trading signals and whatnot. Make sense?
Yes, it does.
This is one of those back of the envelope calculations. Expected move is just the price times the IV times the square root of DTE over 365. And it's a pretty standard formula to calculate the expected range over a specific period. And obviously those three variables are ultimately going to determine what that expected move looks like. We asked the question, what is the most important factor among these three? Do you have an opinion on this?
When looking for expected move, it's got to be the implied volatility if that's what you're looking for. But price is always king. So I'm going to answer the question with implied volatility.
Yeah, I'm kind of in the same boat. All of these factors actually play a pretty important role in the calculation. I'm curious to see what, we're going to talk about in the rest of the slide. But when I think of like the variability or how much expected range tends to change, the first thing that I think about is implied volatility.
Sure,
and sort
that's
of how
going to tell you the range, right? I mean, that's going to...
Exactly, yeah. So how the options are sort of pricing that move in. And then I will also say this is a super handy back of the envelope calculation, but it can also, break down depending on if you're looking at like 1 DTE options, for example. So we just want to be careful about how we use this, even though it's a really handy tool. Interesting argument here. So days to expiration is sort of, we're going to consider that to be the least important factor because traders typically use the same trading duration. We have mechanics around like 45 days, maybe between like 30 and 60 days, maybe not change the calculation too much. So to simplify things, we can really look at price and IV to sort of estimate our expected move and sort of take DTE out of it if we're kind of assuming that there's not going to be a ton of variability in terms of the durations that we're going to look at, which is kind of an interesting argument. So here, price and IV, right, the ones that we've talked about, really ones like factors that we want to really take into consideration in this calculation. Theoretically, the stock price and IV have the same weight in the calculation because they both have a 1-to-1 ratio against the expected move, which makes sense kind of based on that calculation that we looked at, that equation that we looked at a little bit earlier. And we can just go to the next slide to sort of talk about how traders might use something like this. So most traders believe that the stock price dominates the option prices and as a result, the expected move range. Is this true? So to understand that, the research team analyzed the rate of change of the same time frame. Does the underlying price move faster than the IV? In a percentage basis, we used data of SPY and the VIX's change in 30 days in the past 10 years to sort of analyze this. So interesting backtest over here.
So hold on a second. So they're looking at the price of the stock with the same implied volatility?
They want to see if the underlying price move is faster than the IV change on a percentage basis to kind of like see what might have a bigger impact in the calculation. Again, kind of pulling from that estimation that was shown on one of the previous slides. We found that all those SPY's price can be very volatile. The range and speed of the VIX's change is much greater than those of its underlying price. So here we're looking at the daily percent change of SPY versus the VIX. The minimum is 9.8% compared to the VIX being significantly more sort of like volatile than that. The maximum is even a bigger difference, right? When we're looking at sort of these, like the volatility of these moves and sort of what might impact that expected range calculation, right? So when we were saying that like price is super important, but IV might have a bigger impact on like the volatility of that expected range or the changes in that expected range, this is kind of a quantitative way to estimate that.
Showing that volatility is going to be more mean reverting or at least move a lot more than the stock price itself. We always go from the standpoint that, volatility will mean revert back to its norm no matter what the stock's price is eventually, right? So that's the whole key to our selling premium strategy is right here. With it rising so much, hopefully it'll come down in a quicker fashion than picking the direction of the stock price better. So,
absolutely.
So nice little slide saying it in a little different way.
And I think this is also, it kind of like highlights the difference between like what the price and the implied volatility actually measure.
Hmm.
Because right, like an underlying price is sort of this collective decision of a ton of different market participants and a bunch of different sources of capital that says this is the fair price as we all see for this thing. And then the VIX, we're looking at almost like human psychology. We're looking at investor psychology, which can be a lot more dynamic, which can be a lot more volatile, but also can provide a lot of insight into how investors sort of speculate an underlying is going to move. So it's always important to like know the difference between those signals. I think a lot of us do. We trade with both of them, and when to use each one. So I think really
Hmm.
interesting, display of the difference between these two here. To double the expected move of SPY in a month, its price would need to increase or decrease by 100%, which is rare and difficult. We know that with like a market index probably doesn't happen too often. However, an increase of in IV from 10% or 20% or vice versa is not uncommon, and this holds true for all underlyings and their IVs, which explains why IV is really the most important factor to consider when determining the expected move, although price is obviously a pretty important factor in that. So 3 factors impact an underlying's expected move, which is stock price, implied volatility, and DTE. Implied volatility exhibits greater volatility, so our volatility of volatility over here, than the underlying price, and thus has a stronger impact on determining the expected move, and might also have a bigger impact on the variability of that expected move. And we always want to remember that when we're looking at stock price and implied volatility, they're fundamentally measuring different things, and we would use those for different purposes as trading signals.